Hi, everybody. So I got to get started. It's 10:01. I'm alone today, but that's okay. We can still proceed. Let's get to our share. This PowerPoint is a bit confusing, but we'll get through it. There we go. I think that's it. Okay, let me blow it up. Go to the front. Again, I'm not going to use the slideshow view because it's going to be hard to deal with. So let's get started. I've got to be gone by 10:30, so since no one here, it should go pretty quick. So again, we're talking about public projects. When you're doing public projects, these are government projects done for the benefit of society. The objective is not necessarily making profits, but to do something that will benefit society or the residents or the bulk of the consumers, or however not all projects help everybody, but we would like to think that the government takes a lot of people into account when they're doing it. Now remember why we're discounting. The first reason why we have to discount is because we don't want to wait. We're just kind of impatient. That's what we are. We're just impatient. So we got to deal with that. The second problem we have from a whole society point of view is that we have a diminishing marginal utility of consumption. What does this mean? We get more benefits now than we do if we wait, because we think we're gonna, most of us anyway, unless you already retired, think your income is gonna go up in the future. We need money now, so we get more benefits from consuming now because later we're gonna have more money so we can buy more of everything. So you're going to get less well-being for the community if you add extra dollars in the future versus adding them now. So you really want to have more stuff now, because if we wait and wait and wait, we're going to have more money and we're just going to solve the problem ourselves later, or we won't get that same amount of well-being from waiting because that extra dollar in the future just won't be as valuable to us, because we'll just have more money. We won't need it as much. And I think if you're a student, you probably can see that. Like, we need loan programs, we need tuition subsidies, we need this because we don't have any money. But we're thinking when we're 45, we're probably going to have more money. And sure enough, most people consume more when they get in their 40s and 50s. And a second thing we have to think about is, why do we have public projects? Because the private sector is not providing them. Remember, sometimes things are just not being provided in a market economy because there's no way to really charge for them effectively. Or it's too expensive to try and organize the sales end of it, to have the exchange or something like that. It just won't be provided in the private market, so the public has to provide it. Like education. Some people would just not be able to pay for their child's education, but we've agreed that all children should be educated, so we think that it should be a public project rather than a private project. But we could have it be a private project. We don't want to, because the well-being of society would be much higher if we would all have access to education. And lastly is, what should these discount rates be? Well, if you're benefiting society, a lot of times people think they should be lower than, say, for a for-profit. This is kind of some erroneous thinking, and we'll talk more about through this chapter why we think that. We always think that it's okay for the public to blow their money. It's no cost to us, or it's no big deal if the public goes out and spends tax dollars. Or you can spend tax dollars on this and that's fine, but it's nothing that the private sector would be interested in, and that somehow it's okay that we don't make any money on those public projects, or we don't really get a positive NPV. This is very erroneous thinking, and we really need to understand that public projects are very expensive. There's a very large opportunity cost for public projects, and we're going to really dig deep into that. In fact, so deep you probably won't even like it by the time this is over. So what are we actually doing here? So we've got really this discount rate, which is in a public project. Just we're impatient. We don't want to wait. I think we've all accepted that. But then the second thing, which I just introduced, which we've never talked about before, is this idea that we think we're going to be richer in the future. So we'd rather really not think that we're going to get a lot of benefits in the future because we'll have more money, so this won't be as valuable to us as it will be now when we're broke. I'm broke, so this is very important that I have this great benefit from the government. But in the future, I'll have more money and I won't need that benefit. A little bit funky thinking, but whatever. But let's really talk about that. So if we had a 2% economic growth rate, that means everybody's growing at 2%, right? And then of that, that's the utility that I get from spending that extra income. So if I get 2% extra income, how much better off am I? So if I get 2% extra income and I get happier and happier by 1.5 for every 1% it grows. If it goes 2%, then I increase really my well-being or my happiness by 3%. So if this year I'm expecting a 2% growth rate, I can really make myself 3% better off because of this relationship. That growth gives me 3% more well-being, not just 2. Because I'm poor now and I want to have the money now, and this makes me even happier to have it now rather than waiting, because I won't value it so much when I'm really rich. And you will see that, right? When you're really poor, when you get something, it's really great. But as you get more and more money, each individual thing becomes less and less valuable to you. Then what is this next idea, which is, again, the discount factor or this impatience? So this is the utility growth factor. How much you're slated to grow this year and what is really the value to you in increases in well-being from that 2% growth. So that's 3%. Then what's the utility discount factor? If it was 1%, then the real opportunity cost for a public project would be 4%. This kind of increase in well-being because I'm able to get stuff now rather than wait and save for it myself and not have it. And then the 1%, which is my impatience. I just don't like to wait, right? Versus, oh, if I wait, it won't mean as much to me in 5 years as it does now. And again, the government is here to make us well off. So generally, again, the social discount rate that we see is just like this example. We usually have a 4% one, but the actual cost is actually much bigger, and we're actually going to cost that out in this set of assignments. The World Bank and the ADB recommends a 10 to 12% public discount rate, which is really much closer to the private rate. Generally, we don't want to use one that high, and when you look at the federal government, they recommend a very, very small one now. But my suggestion here is if you actually look at opportunity cost of us to actually do some of these public projects, maybe we should use a higher discount rate, because I think sometimes we do some projects that don't make very good sense. For example, this rail thing. How many years have we been dealing with this? How expensive has it gotten? Was it really a good investment of public funds? Maybe we should have analyzed it a little bit more carefully, more like a private firm, and maybe we wouldn't have had so many cost overruns. We tend to treat these government projects as if the money is free and there's no big deal if it doesn't pan out, and oh, we can buy a $500 toilet for a government project because, oh, for the government this doesn't matter. Very, very dangerous, erroneous thinking. The government is spending our money to make us better off because we have certain things the market can't provide due to market failure problems. But squandering money never is going to make us better off. So my argument is this opportunity cost was higher. I think we might make better decisions because we're all making decisions as if this government money is free. It is not. There is a huge opportunity cost. They have to be paid out of either taxes, borrowing money, or printing money. Every one of those three things has a very large cost. So we've got to include the shadow price, the full cost of all those public funds. Otherwise, we're really not going to have a well thought out project. We're going to make decisions based on inaccurate NPVs because we haven't included all the costs and we're using too low of a discount rate. So that really throws off our NPVs. So this is kind of a problem. So again, NPV being greater than 0 might not necessarily be appropriate if the social discount rate that you were using is lower than the market rate, or if the cost of public funds is greater than one, like $1 of public funds doesn't just cost us $1. Maybe it costs us more. And if it does, then we need to account for that cost, right? So either we had too low of a discount rate, we didn't include all the real costs, or we're making an investment that really is so huge that it shuts us out of a lot of other options, such as this fixed rail. By the time we get done paying for this thing, it's going to be very expensive. We're not going to have money to do other things that could have been cheaper, quicker fixes. So we get into this circle where we get this big project and then we can't do other things, and that really is another opportunity cost. Okay, so what is the real marginal cost of public funds? So it includes collection costs, like collecting all this tax money, compliance costs, chasing cheaters that aren't paying their taxes, those rotters. That's expensive. And we don't catch a lot of them. And the deadweight loss, because misallocating resources, again, because we then are taxing in order to raise money to do projects, but you're taxing something over here, which is changing the price over here, but that may not necessarily be what we want to do. Maybe that price was fine, but because we needed tax dollars to do this project over here, now we have a deadweight loss because we have an inaccurate price over there. So that resource and that product or services produced from that resource in that market over there is now distorted. So that's a problem. Normally for the compliance and collection, they're relatively small. They don't go up and down based on the size of the project. They're generally ignored. What we're really going to focus on is this deadweight loss, because we did this over here. That one over there is messed up because we had to raise money to do our project over here. So we did it by messing with that market over there. And you know how I feel with messing with markets. Never a good idea. Okay. So again, we're concentrating on this deadweight loss. So as you're raising more and more public funds, then you have a bigger deadweight loss. Because in order to raise those public funds, you either got to print money, which is going to cause a huge problem in your economy called inflation, which is going to mess with your discount rates, as we've learned. Or you're going to sell government bonds, which is going to mess with interest rates, which is going to mess with other projects and going to create another type of deadweight loss, because now businesses can't borrow money because you've got high interest rates because you're trying to sell all these bonds so you can float projects. So now investors have to make more, and when they have to make more, then their discount rates go up and they stop doing projects. And because they stop doing projects, we don't get taxes from them. Or we just raise taxes, which means we have to go in some market and raise some taxes, and eventually it's going to fall on a household to pay that. So somehow we're going to have a deadweight loss. It's just how that poison is going to come. And it's going to somehow affect either households or private businesses. And then that's costly. Okay, so we've got a deadweight loss. So let's kind of see what NPV is really made up of: the PV of projected cost of benefits. C is the PV of project cost. So we have net present value, just like we always calculated. Present value of project benefits, present value of project costs. Subtract those two. But then we have to worry again about this famous deadweight loss, because you've messed in something else, which is now causing an expense over here to your society. And we got to worry about that. So again, we can mess around with this, but you can actually reduce it to this, right? So we've defined it as the PV of project costs plus the deadweight loss divided by the PV of costs. We can actually pull out the benefits out of it. So we could actually rewrite the NPV rule if we wanted, because we are just so consumed with the problems brought on by this deadweight loss, which most of us probably never even thought about. And as I'm saying deadweight, you're probably wondering what that is. So let me again review. You're either borrowing from the public by selling government bonds. As soon as you sell government bonds, interest rates go up. When interest rates go up, you're crowding out private investors. They won't do projects because now they have a higher discount rate. They are going to invest less in the economy. And when they do that, they will pay less taxes. Because every private BCA we've done here, we have had to pay taxes. And if you choke off private projects, you will have fewer taxes. That's how it's going to be. Or we can borrow money from the central bank by printing money. As soon as we do that, we have inflation. That's what we have. So when we have inflation, again, discount rates go up. When discount rates go up, we have fewer private projects, less taxes. Or we can raise tax rates, and as soon as we do that, we have distortion in other markets, and there's a misallocation there, and we suffer a loss there because people will stop buying in those markets where we've raised those taxes. We will, in fact, reduce consumption. And we will then pay less taxes because we're consuming less. So again, what you're really looking at is this idea that you're driving out people's behavior, either private investors or households, so that they are doing less and we are making less tax revenue. And I bet you never thought about it, but it's true. So many people see tax revenue as a freebie. It is not a freebie. It is very expensive. Nobody likes to pay taxes. So again, before you start squandering money on projects that are going to suck down tax dollars or result in fewer tax dollars, really do some thinking about those projects before you do them, because unless they're really worthwhile, you should avoid doing projects that are going to cause this problem or cause, be very expensive, but we don't really ever even realize this is happening. So this is really one of the things we need to think about, because so many people will just want government projects as if it's free. It is extremely costly. And you see now, when you get done with this thing, why we like private-public partnerships, where the private person comes in and does a lot of this. That becomes cheaper because it doesn't affect tax revenue. I know it sounds unrealistic, but it's a fact. So let's move on now then. An example. Deadweight loss from selling bonds. $100 worth of government bonds is sold. When you sell $100 worth of government bonds, it has two effects. One is you're not spending it in the marketplace, so you're not buying goods and services, which produces tax dollars. Secondly, you're not having private investment. So then that reduces tax dollars. So how exactly do you account for that? So tax rate on the returns to private investment is about 1/3. At any rate, right, this comes out to be, since the after-tax return on private investment has to eat the government bond rate, that's just an equation that it gives you, then it gives you this equation, and you can then use that to calculate what the actual return would be. Let's go to the next one. So the cost to the economy. So here's our equation. And then we now go forward to try and figure out this answer. So the loss of $50 worth of private consumption costs us $50. $50 is not going to be running around in our economy, generating income and getting taxed as it generates it. It's just not going to spend, right? So there's that $50. And then the $50 worth of a private investment would have yielded an annual before tax return of $50 times whatever their rate was, right? So up here, that rate is equal to 1 minus 1/3, right? Equals R. So what is R? R is, again, right? We can solve for this right here. So R star equals 1.5 R. So we can just plug that back in, because right here, if we take this, put it on this side, R star divided by R equals 1.5. So $50 times 1.5 equals 75. So in fact, the mere fact that you didn't have that private investment cost you $75. $50 would have been a return to the private business person, and 1/3 of that, $75 or $25, would be the taxes that the government is now not getting. So what is the cost of this public project, which could have been done by the private sector, but we're going to do it in the government instead? $50 in consumption that didn't happen, and $75 worth of private investment profits, or private and BC, that didn't happen, right? So we've got $50 plus $75 equals $125. So the really loss of this thing, it doesn't cost us $100, it really is costing us $125. So it's more than the cash outlay for the project because of all the stuff we gave up in lost taxes or consumption. And this is the startling thing to people because they always think that government spending is free. In fact, it's more costly than having a business do it. So anytime we're saying, oh, don't have a business do it, the government will do it, costly. And this is how you figure that out. So the deadweight loss is really resulting from the tax revenues. You're not collecting any additional tax revenues that you would have collected if it would have been a private project. So that's what we got to remember. Eventually, all taxes are borne by households. We have a lot of taxes we pay, but they're all borne by households. But in these examples, we're putting it in one tax rate. We're not having 15 different things we're getting taxed on. We're just making it simple, for example, to show it to you with one tax rate. So don't get thrown by that. There's a lot of ways we raise taxes, but here in these examples, I'm just going to give you one tax rate because I don't want you to go crazy. Well, you're probably already going crazy. It's kind of hard to understand. But if we just have one tax rate, you can easily work through these equations. So again, let's say that when you want to raise additional tax revenue, for example, let's say that you do it here. So we're saying, okay, so we want to raise taxes. So instead of getting this wage rate here, we're now at here. So you can see an example of this deadweight loss of, okay, we raise the tax rate. So why does tax rates create this problem? Before we were talking about government bonds. Now we're just simply raising taxes. So we're raising taxes. What it does is effectively reduce our wage rate from W0 to W1. So we're actually producing quite a loss, right? So the after-tax wage falls and the quantity of labor falls. So we're going from here to here. So the cost to the households of the tax increase is the loss of the producer surplus. So it's A, B, D, E, and B, D, C, I believe, yes. So the consumer surplus, we were here, but now we're here. So we've lost this whole thing, this little triangle, which is BDC, and this DEAB. So that's all now being lost because it's all going to the government in the form of a tax. And the extra tax revenue, well, it's not all going to the government in the form of the tax. The extra tax revenue to the government is measured by ABDE minus FGCB, FGCB. So this is actually the amount of taxes they're getting because it's this amount of labor, right? And there's the tax rate right in here. So again, the extra dollar of additional revenue is the ratios of the cost to the households, this, to the extra tax revenue. So again, this was the formula we saw before. This is how it looks on a graph. You don't have to do the graphs. I'm going to go through examples where you can just copy what I did. But what it does is tells you what that additional deadweight loss, just what we figured out with the equations. So what it basically does is divert labor from work to leisure. So you're really, when you're cutting back your amount of labor, you're just sitting around and you're really having this deadweight loss. Okay. And there's other problems, right? When you work less, how do you pay your Social Security? How do you do other things? If you're not working, you're not paying no taxes. So that's a problem. That's a loss. We got a problem, right? We need people working to pay taxes. So that's another problem. So let's just talk about it in general. In Australia and other OECD countries, they're kind of really have worked through this several times, and they're seeing the marginal cost of public funds are in the 1.2, 1.3 range. So anytime we do a public project versus a private project, that's what it's costing us, about 25 cents more than the out of pocket. So this is really needing to be reflected as a price of a public project and needs to be accounted for in the BCA. So here's kind of an example, which is kind of what you're going to see in your homework. So $100 worth of public funds is sold. So $50 in private investors increase their savings by $50 and reduce their project investment by $50. The opportunity cost of lost consumption is in fact $50. But the opportunity cost of foregoing the public investment is the present value of the foregone before tax return. So again, R star divided by R times 50. Right? So now we have to figure out what R star divided by R is. So it'll tell you in the problem what R is. That's the tax rate. Oh no, it's the consumption or the marginal savings rate, I believe. And then there's the tax rate. So you can just plug these into this formula and it will give you what R star is. And once you know what R star is and R, then you can do this multiplication and you get this magic little number of $83.33. So the cost of this thing is $50 for the foregone consumption and $83.33 for the foregone investment, gives us a total cost of $133.33. And what you have to have is, here's the public funds that you raised, here's how it affected savings and investment. Savings goes directly as a cost. Investment, you have to figure out the opportunity cost of investment by looking at what taxes you're giving up. You do that by getting this rate and this rate, plugging them in and solving for R star over R. Well, actually what you're doing is you're getting a number for R, and then you can just put it right into this equation and you already have R straight without the star, and you're done. Pretty simple. Okay, so the last issue we got to talk about is the value of information. Information has value. Sometimes if you wait, you can get a more accurate picture of NPV. For example, we know the price of output now, but we don't know what the price of output will be next year. But if we wait a little bit, then maybe this will become more clear. So sometimes you get better information if you wait. So that's really what we're talking. And your book has a formula that you can just plug right in, but you need to know some things. You need to know all this stuff. The project cost, the net benefit of now, right? The net benefit now. The net benefit 1 year from now if you get the high price, the net benefit 1 year from now if the low price happens, and then you'll have to know these probabilities. So it's just a straight plugging in for the information problem. And in your book, figure 10, they kind of draw this out for you. So if you wait, you go down this route and you get two different numbers for the expected NPV, and you multiply them by these to get the ratios of how much each one counts. And then if you invest now, this then becomes the NPV. So you just simply plug it in. And if information is valuable, then the NPV should reflect this. If not, then they won't. And as you have a higher initial investment and you have a really bad return if it goes sour, then information is even more important. If the investment is not really high dollar and there's not a huge cost if you make a mistake in your estimate of the price, then not so bad. But if you're going to lose a lot of money, then sometimes waiting and getting better information is worth it. And again, it's all on the bad news. If it turns out better than you expected, you're always going to get a higher NPV. You're happy. And I say this all the time. If I get more than I wanted, I'm down. No problem. But I want to protect against big losses. So we're really kind of looking for, okay, if I knew with certainty. But let me also be clear. I say these things like we can actually get this information. And the problems, you'll get this information in real life. You really need to say to yourself, how sure am I that this is going to actually happen? So all you really need to do is simply go through this thing and plug in, because the problem will give you information for all these things, right? And then here's the NPV if you wait. So this is the NPV in year 1. Here's the NPV in year 0. So to compare them directly, you may have to discount the waiting one back one more year so you can compare them head on. So it's right from the book, and so is the other assignment question right from the book. We've gone over both of them, and you should get the data and the problem to answer the question. Okay, so there we are. I'm going to stop the share and end the meeting. 4th of July next week. For those of you who have turned in nothing, please get on it. We have one graduate student that has not turned in anything. Everyone else is slowly working through it. So you'll get there and see this webinar. And it should be pretty clear, because if you look at the example in the book, listen to the webinar, you should be able to get through these assignments or assignment questions for Chapter 10. And again, why are we concerned about it? Because public projects are way more expensive than we think they are, because we're crowding out private investment and crowding out consumption. And as soon as you do that, it's an opportunity cost, and we need to account for it. Okay, thank you.